McGraw-Hill Professional presents The Rise of Carry, The Dangerous Consequences of Volatility Suppression and the New Financial Order of Decaying Growth and Recurring Crises. Written by Tim Lee, Jamie Lee, and Kevin Coldiron. Narrated by Todd Belcher. Preface. The authors began work on this book about 5 years ago. The original motivation was partly frustration with the inadequacy of standard explanations of how central banks' unconventional monetary policies had supposedly been working to support the economy since the global financial crisis. We recognized that the key was the suppression of financial volatility that the interventions of central banks and governments have engendered. This has become much more obvious over the years since we began to work on this book, but the full implications of the growing dominance of carry trades have yet to be understood. From a purely financial perspective, the book contains a number of insights. Among the most important are the relationship between volatility selling and leverage, and how these together make market dislocations inevitable. The consequence that the economic cycle is now a function of bubbles and busts in risk assets in the context of an overall tendency to deflation, and the manner in which these factors have combined with the centrality of U.S. markets, particularly the S&P 500, to the global market structure, transforming the S&P 500 itself into a carry trade. Beyond that, we recognized, and try to convey in this book, that at the most fundamental level, carry or volatility selling is an aspect of the power structure in society as a whole. Central banks should be perceived as agents of this power structure. The conventional understanding of the forces that determine the financial markets and the economy is inaccurate, and accordingly has no hope of shedding any light on the next financial and economic crisis and its consequences. In the book, we explain in some detail the mechanics of carry, or volatility selling, trades, but our purpose is to explain how these trades fit into and help create the bigger picture, a picture of decaying economic growth, recurring crisis, rising inequality, and fraying of the social fabric. Although some of the finance material may be difficult for non-specialist readers, it is simplified relative to the treatments in textbooks on derivatives or foreign exchange markets. The book is not intended to be an alternative to such textbooks, nor any kind of manual on options or currency trading. A detailed technical understanding is not necessary to grasp our basic conclusions. Tim Lee, Jamie Lee, Kevin Coldiron. Chapter 1. Introduction. The Nature of Carry. Why have stock markets, over the past 25 years, experienced huge rises and crashes? Why did the U.S. stock market, in particular, quadruple over the years following the 2007 to 2009 global financial crisis, even though U.S. economic performance was, at best, so-so? Why do companies keep buying back their own shares rather than making real investments? Why do professional stock market investors and traders hang on every word that central bankers utter? Why does it seem that everyone wants to live in the big, overcrowded global cities such as London and New York, even though new technology supposedly allows us to live and work almost anywhere? What explains the rise of populist political movements? Needless to say, any attempt to answer all these questions thoroughly would require a much longer book than this. But the starting point to answering them requires a perspective through the narrow prism of financial markets. The behavior of financial markets today is not, as is commonly believed, some function of the economy, or interest rates, or the result of political developments. It is a manifestation of the rise of carry, or the suppression of financial volatility. The rise of carry can be understood as part of a much broader phenomenon, with implications for all aspects of human affairs, but its expression in financial markets alone has had profound consequences for the world. What do we mean by carry and carry trades? Carry trades make money when nothing happens. In other words, they are financial transactions that produce a regular stream of income or accounting profits, but they subject the owner to the risk of a sudden loss
Sample complete. Ready to continue?